In 1942, an 11-year-old Warren Buffett took $14.75, every penny he had, and bought 3 shares of City Service Preferred. At the time, his approach to money looked identical to the strategy used by millions of retail and crypto traders today. He spent his first 8 years as an investor obsessed with the technical side of the market. He read classics like Edwards and McGee, mapping historical price patterns on a grid to predict where a line would move the next day. This ticker tape illustrates his initial fixation. He viewed the stock market as a stream of disconnected price data points. This mindset creates an emotional trap. When you believe your net worth is defined by the next tick on a tape, your internal state follows the market's movements. You feel euphoric when the market rises and panicked when it falls. Buffett later realized that 90% of retail investors stay trapped in this micro-level predictive game, ensuring they remain anxious and set up to lose. The shift happened at age 19. Buffett read The Intelligent Investor by Benjamin Graham and rejiggered his mental model for how wealth is actually built. He stopped buying stocks immediately. From that point on, he never viewed a ticker symbol as a tradable piece of paper again. He began purchasing ownership stakes in businesses. These were productive entities that happened to be publicly traded, but his status changed from a trader to an owner. Redefining yourself as a business owner removes the weight of short-term volatility. If you own the business, the daily price is no longer the metric of your success. Imagine the stock market simply ceased to exist for the next 10 years. No quotes, no tickers, and no way to check your balance. If you used your savings to buy a private farm, you would evaluate that investment based on the acreage and the density of the soil. It is a physical, productive asset. This chart compares annual crop yield against the chaotic daily price line of the land. A farmer evaluates success based on the yield, the actual corn produced, while ignoring what a neighbor might offer to pay for the field on a random Tuesday. A drop in the market price of land actually benefits the long-term farmer. It provides an opportunity to use current profits to expand your holdings and acquire more output for the same cost. Wealth building relies on intrinsic value and cash flow. When you focus on these metrics, the daily fluctuations of a ticker become irrelevant. Buffett applies this same farm logic to multi-billion-dollar public companies. He looks past the ticker symbol to see the machinery and customers underneath. This orientation makes market crashes a source of happiness. He sees a downturn as a temporary discount at a store he already plans to shop at for years. This strategy is accessible because it doesn't require a 170 IQ. As Buffett says, a high IQ might actually be a hindrance. What matters is the psychological discipline to stay oriented toward ownership. Treating the market as a mechanism to acquire productive assets at a discount creates an asymmetric advantage. It turns time into a tool rather than a source of stress. Buffett keeps at least 80% of his money in American business. He is betting on the collective output of these factories, laboratories, and transport networks. Consider John D. Rockefeller, who was the richest man in the world when Buffett was a child. Despite his immense fortune, the bottom 2% of earners in America today live with a higher standard of comfort than Rockefeller could buy with all his millions. Modern medicine and dentistry, products of private research and corporate engineering, allow a minimum wage worker to receive better care today than the world's first billionaire did in the 1930s. This logic extends to entertainment. An hour of labor today buys instant, high-definition access to every sport on Earth, while Rockefeller's era required traveling to sit in the mud of a field like this. When you buy a business, you are buying a slice of this compounding efficiency. You own the entities that develop the medicine and build the screens, profiting from the steady advance of human living standards. Enterprise is a powerful engine. A population representing 0.5% of the world's people managed to produce over 20% of the world's total bounty through this structure. Owning a business is the mechanism that connects your personal savings to that historical momentum. Stressing over a one-day dip on a stock chart ignores the larger reality. You are participating in centuries of upward momentum. Wealth generation is the patient act of owning human progress. If you have the right orientation, you let time do the heavy lifting.